Hello, I'm Emilie Bellet, founder of Vestpod and author of You're Not Broke, You're Pre-Rich, and you're listening to The Wallet. Every week we bring you the best tips, guidance, and a good dose of inspiration and motivation to help you manage your money better. Today we are talking about how to build an investment portfolio, what that actually means in practice, the difference between stocks and funds, and how impact and sustainability fit into investing without overcomplicating things. I'm joined by Caroline Brady, who works in impact investing at Net Purpose after spending over a decade at BlackRock. Caroline has spent years analyzing companies and markets, and today she's helping us understand how investing can support your long-term goals. Just a quick reminder before we start. This podcast is for education and not financial advice. Investing carries risk, the value of your investments can go down as well as up, and we can't predict the markets.
I found this company called Net Purpose, and now I am head of partnerships. It's quite a broad remit. And I work for a very inspiring CEO, founder, who has also come from banking. And she was head of impact at a private equity company. And she had seen a lot of the inefficiencies in the way sustainable funds were managed. And so has built this tech platform to help investors do their investing more efficiently and sustainable. Investing, whether that be sustainability, impact investing, ESG, so really helping a whole suite of clients. So
we're going to talk about investing today. You're going to share maybe your experience as an individual investor. You worked with institutional clients, so that's quite different. But maybe if we just start with the beginning, sort of the definitions. When you invest, you're usually building a portfolio, so you allocate your assets. Can you tell me a little bit of where we start with maybe portfolio building and what does that mean?
like everything in finance, there's a lot of terminologies that get bounded around. There is this idea of asset allocation and portfolio construction. And you can think of these two things as top down and almost like bottom up. So thinking, and I read something somewhere which I really like, the idea of when you're designing a house or you're thinking about where you want to move into a home, you need to know how many rooms you need for your family. Do you need a study? Do you need 2 rooms? Do you have children on the way? So that's the structure of your home. And that can be thought of as asset allocation. When you think about portfolio construction, that's more like building the interiors. What's embedded in those portfolios, or what's embedded in those rooms in your home that you're designing, the feel of it, the structures of it. And so if I bring that back to finance, you're thinking about assets are things like fixed income, which is credit, bonds, all the same thing, equities, which make up quite a big proportion of general asset allocations, and then other things that you can fill up asset allocation with, commodities, especially some of the metals and commodities right now are so important for the energy transition, but also like gold for a safe haven asset. When there's geopolitical tensions, you want to have some of these maybe safe assets. So I won't go into too much detail there yet, but on the portfolio construction, that's thinking about, do I want certain themes, trends? Do I want to hold specific companies, single stocks or companies in that portfolio? Or do I care about a specific region? Do I want to be leaning into information technology and the AI bubble, which I'm sure we'll get onto, whether or not that's a bubble? And really seeing what you can fill up those different asset classes with. Now, generally, most people that do have a pension fund will be advised to have different segments of those two things. So it's generally accepted in the UK and in developed markets, the way our pensions are structured are when you're younger, having more equities in a portfolio. And as you reach closer to retirement age, being able to increase the credit or the fixed income allocations because they're seen as less risky. And when I mean less risky, there's less big swings in prices. And so when you're getting closer to retirement, you don't want that swing close to when you want to be taking home your pension pot. So those allocations over time would switch based on your risk tolerance is another way of basically saying that move through time. Your risk tolerance generally goes lower as you get closer to retirement.
I think people are tend to be worried about the term risk, but risk is not necessarily a bad thing. Can you tell me what is your own definition of risk?
Yes. So my own definition of risk, which is probably tied to broad definitions of risk, is as you rightly say, a risk is it sounds scary. It sounds like there's a definite possibility of a negative outcome, if I just take that as an English language word. But really, risk is the risk that there's volatility in, say, a share price or your portfolio value. That volatility can be a positive thing. You can have massive gains, but it also means that there could be drawdowns, which means when a price of a security reduces. So risk can be tied to volatility is one thing, but equities are deemed to be more risky than fixed income. But look at the equity market. If we've looked at the equity market over the last 60 years, that's generally a horizon for our lives to be saving. Um, there's an exponential growth over time of equity securities. Now, day to day, there might be volatility and risk in those equities, but overall, if you're taking the risk, you are more likely to, over a long period of time, receive return, receive reward. So you take this calculation or you think about it, if I'm taking more risk, I am more likely to get more reward over a long cycle. If you are taking very low risk, you're very unlikely to be beating inflation or interest rates.
And for someone who's getting started, so I feel some of you are listening, you may have already a pension, so you're already an investor. You may have money invested via maybe a robo advisor. So maybe someone has been, building these portfolios for you. But what about these, DIY investors or someone who want to build their own portfolios? How can they get started in a simple, simple way? Because that could be quite overwhelming.
It is. And it's even overwhelming for people closest to me,
Yeah.
even though I can give insights into it. And as you rightly say, most people will have a pension. And if you firstly get to know what's in that pension, often you might know the name of that fund, but what's actually inside that fund?
Yes.
What is your equity fixed income ratio? And then what funds, what portfolios? So portfolio, otherwise another word for fund. What is within those? What names do you recognize? Do you understand the companies that are invested in? A lot of them are going to be US. So because the United States has had such a strong run in equity, this is now making up like 70% of global indices. And we can get on to the difference between passive and index investing versus active. So feeling and understanding what's in there, because you don't want to be firstly over emphasizing some of those companies. So if you're very heavily invested in a specific tech stock, do you really want to be investing in that specific company again in your own trading portfolio? So understanding that total exposure to where might be a bit hidden and you don't have that full view. And you can ask your pension platforms to get insights into that and ask for the holdings, ask for that granularity because it should be available to you. And then it's where do you get started? I would always suggest to start small, be willing to lose what you are putting in. And that is just getting a feeling for how a stock price moves. And I'm going to focus more on stock price because that's generally what people feel more close to, and it's an exciting way to get into investing. And you've probably got quite a lot of fixed income or government bonds in your portfolios, in your pension funds.
Yeah.
So looking at, okay, what do I know? What am I more familiar with? If you think about the most successful companies globally that have really stuck around for some time and have driven massive returns, these have been names that we're really familiar with. Microsoft, we're sitting on our computers all day, looking at our laptops or our computers, that we're using these devices day in, day out. iPhones, Apple has been such a strong one. We're using our phone all day, we're glued to it. Facebook or Instagram, that's something else that we're looking at. And so I always try to bring this real aspect to a decision. This is a company, it sounds complicated and it's a stock, but really these are everyday things that we are using that's helping to drive up the success of a company. So are there other things in your life that you are really close to and you can see it's a really strong company, it's run well, the product is strong, and do a lot of reading into that. There's lots online. There's lots online around, even with ChatGPT and some of these platforms to ask really specific questions on how has the, say, earnings been over a period of time. And you look to see, has that been stable? Has that been, I wouldn't want to go straight into investing for the first time in a company that has big swings in its earnings and its share prices all over the place, but rather something that you are interested in and you want to keep reading about, whether that be a luxury item in a luxury company you're fascinated by, or homeware products or companies that are helping bring homeware. So things you can feel, because I think the most important thing for me when I've picked stocks is if I don't have a passion and I'm not familiar with that company, I'm not going to be looking into it. I'm not going to be following the news and knowing when there might be a moment to really come out of that investment, or I need to know specific information around it. So, or in a nutshell, it would be familiarizing yourself with a company you're already really quite close to. You understand what makes that strong. You are maybe a buyer of that company's product or service. Doing your reading to understand, how does management operate? How have their profits been over time? Are they quite stable and growing? Are they able to, grow profit margins? And then reading through the latest news around that company, and using a platform to maybe invest an amount that you feel comfortable if that amount does half in price or fluctuates through time.
This episode is sponsored by MoneyWeek. MoneyWeek is a weekly financial magazine written by great journalists, and it's one of my favorite ways to stay on top of money news. More than 20,000 people read MoneyWeek every week, in print and on the app. You get investment ideas, market news, economic trends, and practical guidance on things like ISAs, pensions, and savings, all in one concise and jargon-free format. You can try 6 issues for free, then the Wallet listeners get an exclusive £5 discount on the quarterly subscription. Visit moneyweek.com/wallet and enter the code WALLET. Now, it's great that you've talked about funds and stocks, and probably people are starting with funds because that's what they have in their pensions. But also for anyone starting, it's probably less risky to start with funds. Can you explain what are the different ways, maybe the different types of funds, and why that would be a good idea to start there before we go and dig into the sort of really exciting, stock picking?
It's true, and that's a good place to start. Now, funds are made up of, there's different types of funds. So you have index or passive funds that track an index, or you have actively managed funds. Now, generally, I would always suggest, or for myself personally, I would be going into a global index fund. This is investing and tracking what are some of the major indexes that are holding some of the most successful companies with the biggest market caps. What I mean by market cap is market capitalization. So how big is that company and how big is that company's revenues and space in the equity markets. Generally, they have proven themselves through time, and so they're heavily held in these major indices. And it's a well-diversified set of often hundreds of companies that when you take the average of those companies, you have less volatility through time. And so what I would say is having the majority of your investments, or the first investments you make, to be in index funds at least allows you to be participating in financial markets. You've got your foot in the financial markets and you're benefiting from the largest companies continuing to do well, but also spreading that volatility across hundreds of companies. So if one does badly, then the others are lifting it up.
Perfect. No, I love the fact that, if one company is not doing well, as you say, it's going to be replaced by, maybe the next company in the set that will then be included. So
Exactly.
At least you're probably getting the best of the market for certain maybe geography or industry, or something quite global if you talk about global funds.
Absolutely. And then if we think about still index funds, but if if you are really interested in a specific theme, if, you could take robotics or information technology and AI, there are dedicated funds that you can find that are just for that theme. They're called thematic strategies. So if you really believe in a long-term tailwind of a sector or adoption of a sector, like we've seen with tech, maybe you can also have a small portion of an investment in a specific theme because that's something you really believe in. And again, these are tracking an index that's been pre-made. There's multiple holdings in there. And by holdings, I mean many companies. So when one is taking the market share, that's helping to lift up the total value of that index. Now, on the active management side, which is where I've come from, we ran a global impact fund, which was invested in global companies, but it was actively managed. We were selecting the companies that were in that fund. But again, it's a fund. So within the fund, you have between 50, 100 companies that have been pre-selected by a professional this is what they do day in, day out. Normally, a lead portfolio manager has plus 10 years experience. They are well-versed with finding the right companies to invest in for the risk-return characteristics of a fund. And these are still a collection of companies, but you are putting your trust in a fund manager, otherwise known as a portfolio manager, to be making those decisions. And there's a vast array of active funds that you can choose. Again, if you're going into active, it's normally a slightly smaller set of companies. So as I said, you're in the more 50 to 100 company portfolio rather than sometimes hundreds up to thousands in an index fund. So we talked about risk earlier, jumping from index to active, there is more risk involved in that, but often potentially more upside and reward. And for those funds, you are investing in the person, that portfolio manager and to select those kinds of funds, I'd be wanting to see what has the past performance been of that investor. What are all the funds that they run? Are they running too many? Or do they have one standout fund that really is their sole focus? And you can look at this information online. Again, you can select a global, traditional active fund, or you could select a sustainable global fund, or be very specific around a specific theme like AI that you would want to be invested in.
Amazing. And there's also a difference in cost between active and passive. And I feel people are already talking about the big debate, should we go active? Should we go passive? So can you talk a little bit about maybe, the cost and where do you start?
So the cost piece is index investing. It's like a commodity now. So you should be able to invest in an index fund at very, very low cost that you really shouldn't be saying this is 0.00% of your fee. Now, because the active fund management process takes a team. It takes a team of analysts. These are teams of people that are doing the research on stocks. They have portfolio managers. The portfolio managers are making investment decisions, and they're highly skilled at what they do. So there is an embedded cost because you have human stock selection happening. They are dedicated to these, and it's almost your eyes and ears on a portfolio. If you feel like you don't want to be checking an app every day to see where your stock, how they're doing.
You definitely don't.
That in itself, like measure the amount of time you're spending doing that stuff and work out, okay, I probably want to outsource that to someone who really is having the conversations with the portfolio companies. These active fund managers are sitting down with CEOs of companies to really ask them questions on what's your strategy, what have you done with this change in dynamic, geopolitical risk. These are the questions, and they're able to get to the source of the companies. So there is an embedded higher cost. Now, it's not massive. Often it's, a percent, but it's still something that you can feel. Now, net though, over time, in some cases, active funds or funds with portfolio managers managing them have outperformed index. That's their target. If they're not outperforming an index, then over many years, they would probably not be in their roles for long. So you are paying for that expertise, and you're paying in the seeking and outperformance of a market. And so to be able to participate in that, or outperformance, otherwise known as alpha generation, you are putting your bets in a active fund manager.
So I understand that we're talking about active funds versus passive funds. But for me as an individual, I could have a passive approach to my investment or more active approach to my investment. How do you, approach your investing, for example?
I do have a combination of index funds because I have a pension, and that's all predominantly in index funds. That's government bonds, that's global index funds. But because I've been in an active fund management team, I'm well versed, and I believe in the process that it takes and the know-how and the expertise that there is in these active management teams. And so I'm always looking out for an investor that just is able to compound their growth of their portfolio year in, year out, and have solid returns. So I like to find fund managers that I can do that research into, but also that have strategies that align to my objectives as a person, which is believing that the future of our world and society needs to be operating in a more sustainable way. I believe over the long term, the companies that are going to be winning tomorrow or when I'm retiring are those that have been able to do more with less resource intensity, that are able to provide positive communities, that are driving healthcare solutions. And so I often will be looking for a fund manager or portfolio manager that has a similar view to the future state of the world. And that can often be seen if you look online, and it's the objective or the focal strategy. And normally it's pretty digestible, and you can see the objective of this fund is to outperform global markets, and we care about sustainable outcomes of companies. So that would be for me, but for others, that might be a different mission.
So let's say you really like this fund manager, you like the holdings. I feel that's also a great way to learn about picking stocks, because you can look at how, they're changing their portfolios, reading the reports and stuff like that. So how would you start if you were, you had to pick one or two or five stocks, knowing you already have a balanced portfolio of funds on the side, but maybe you're really interested in some specific companies?
So this comes back to the idea that some of the most successful companies that we've had in the last 10 years have been things that we're most familiar with. As I mentioned, the iPhone, Microsoft, Netflix. We go, after working on our Microsoft, we go home and we watch Netflix, and we well, not all of us, definitely not me driving a Tesla. But, there is that move to electric vehicles, and Tesla has done well. And we haven't got on to NVIDIA yet, but this AI revolution. So I would start with top down. What is a theme that I think when I want to retire is going to be an important industry or theme? The AI is doing so well because this is like the new industrial revolution. This is our industrial revolution of AI is going to change the way in which we operate, we do our jobs, we interact online, and we do our research. So it's really turning things on its head. So hence why AI has been such a successful area. But also AI is very heavily embedded in some of the index funds. So I'd start to look online, what companies have done well. If you're based in the UK, that your household names like Marks and Spencer's, let's look at that and be like, do I understand what that company's product and service is doing? Do I know that that company's products and service has been driving revenues for a long period of time? Can I look at that company and see that the volatility maybe is lower than some of its peers? And do I really believe in that company's brand, reputation, the management? Has that been a management team that's stayed? And once you find a company not a company that's just had amazing returns, because you don't want to be following a crowd necessarily, but really something that is well run and has had stable earnings. Now, stable earnings growth through time has been one of the strongest indicators of long-term returns and success of a company. So to put it in simply, I would always look to have my first stock investment in something that I am familiar with and I understand, and me myself am my purchaser of that company's product or service. If you're a runner, maybe you look at Garmin as your watch and you know that the products have been really top of the range. They're innovating more than their peers. All of your running friends also have a Garmin watch and you really believe in the product innovation and the future of that company. And so there are many sectors out there. There might be, in the healthcare space, look at what healthcare has been able to do for, first it was cardiac disease, but moving into obesity and some of these GLP-1 treatments that have helped really change the course of obesity in the US and across the world. Finding these really important milestones that are helping to innovate in a new direction faster than ever.
And do you have any ratios you will be looking at? I mean, there's so much analysis you can do on the stock. So of course, it's understanding the company management, expectations, estimates. But can you point us to like a few ratio or maybe an easy methodology on how to look at stocks?
Yeah, and you can quickly get really in the weeds of a lot of these metrics. And to be honest, they're super overwhelming. But really, what makes up a company's success is what are their revenues? What are they selling? And are those revenues translating into profits or earnings? Are they able to maintain those profits through time? But also, what's been a really important metric is debt. What is that debt ratio? What is the percentage of that business that compared to the returns that it's making that it's held in debt? So they're borrowing money to be able to do innovation or research or grow. Now, that debt ratio is important, especially when we have rising interest rates. And that's an environment we're starting to come down, but it's an environment that we've been in for the last year or so. When rates are high, just like for us and our own mortgages, our mortgage rates are high, but for these companies, they are having to pay back that debt.
And it's more expensive.
And it's more expensive for them. So you want to be careful that in times of high rates, that you're not investing in companies that have really big debt ratios compared to what they're earning. So that would be a good flag to look out for.
And with stocks and with funds, we've talked about diversification at the beginning of the episode. If you could explain diversification in one sentence for long-term investors.
I would say it's not putting your eggs in one basket.
Yeah.
Is the one sentence.
I love it, yeah. Simple.
Yeah.
Everyone knows what it means. Yeah. Now you used to work in more active management. Is the process more or less the same as what individual investors would do? I mean, I guess it's a lot more in-depth, but is there anything different that they do?
Yeah, there's a lot that they do. This is their full-time role. But there's also a lot of noise and naming of things and terminologies that are actually quite simple under the hood, but actually they're made to be super complicated. And that's just the history of finance has created these taxonomies and terminologies to make things sound harder than they are. But of course, we have our day jobs. As an investor, you're not going to be able to be spending all day, every day doing the reading. You want a good source of information, trustworthy, and to be able to have a long-term investment in a company. So what is different? I think I'll start with what's the same. So what's the same is reading a lot of information on the company, tracking how that performs through time. So looking and checking on your own investment portal or the investor looking in their own portal. That might be Bloomberg for the investor, but it might be a digital wealth platform for us. So keeping an eye on that is similar, and following the returns through time. And so they're the same areas. But where there's a big difference is a professional manager will be able to have access to the C-suite, the CEOs. They will be able to, I was able to have a conversation with the CEOs of companies to ask them the relevant questions about what I thought was going to be an important tailwind to their success. That's a bit harder if you're just investing in stocks, but it's still so much online that you can look at interviews. You can really get a sense of what that founder or that CEO's mission is. And often CEOs or managers of companies that are either the founders or have been in that seat for a long time and have the technical expertise of what that company does has often been quite strong. So you can find those pieces of information from looking at videos online, interviews, reading what's been written from that founder. So you can get close to what a professional manager is getting to. What's different is there is layers of oversight. So in a actively managed fund, that portfolio manager is having weekly and monthly check-ins with the CIO. So that's the chief investment officer that most asset managers will have. That investment officer will be looking at what is the risk you're taking. Are you taking unintended bets? They will be looking at the volatility of the fund, and they'll keep the manager in check to make sure that they're not going out of the perimeters of what's been accepted and agreed as part of that fund's objective. There's a risk team overlaying that are also looking at the data every day to track. And then there is product strategy teams that are helping to think about how they talk about and educate the market on those funds. So there's a lot of inputs into that, but really it's reading, understanding, tracking, and measuring the risk.
I think it's really interesting what you say. It's because I think as individual investors over the years, we're getting a lot more information. I think there's a lot more information available with internet now, with with AI, social media. Also, people share a lot of information. It's overwhelming also sometimes,
Yeah.
and that's going to impact your behavior and your emotions. So that's also probably the one of the differences that's going to happen.
Absolutely. There can be hype. There can be
Yeah.
hype around these names. It sounds really exciting. Everyone's getting into a company. But to read what you see, to take a step back and to think about the long-term expectation for this sector and do the reading, put the time in. And it's not months and months of reading, but it's just being understanding what makes that company tick. Reading outlook reports from asset managers, they're all putting these out. What do they think 2026 will bring? A reduction in the interest rates. So does that mean maybe some of the smaller companies that have a bit more debt, they can start doing well again because they're not spending as much? So it's taking bits of information, but not getting too bogged down
Yeah.
in the detail of it.
The day to day.
Yeah.
And a question I'm often asked when we run our workshops around, building a portfolio, investing for the long term is, when do I sell my investment? So of course that's going to be different depending on the type of investment you have, but do you need to have a strategy in place when you start buying and picking investments in terms of I'm going to sell at this point or I'm going to sell when the investments went up or went down? What are some maybe tips around that?
It's scary when there is a drawdown on a day. Trump says something and then the stock market plummets. But what you see is there's a correction from that. And so I started by saying it's scary, but actually some of my most successful investments have been where there's been a market movement in a day. The day we got sent home from, I was about to say school, the day we got sent home from work with COVID, the company's stock price really bottomed out. There have been moments in time where you look at these companies and you think, these are going to be companies that are going to we're still going to need groceries. We're still going to need healthcare. We're still going to need to go on trains. And maybe not throughout COVID, but off the back of that, there's still that need for some of these sectors, like a Unilever. I still need to buy toothpaste and food, and so really, does that drawdown warrant me to rush out and sell, or do I invest at that time? So, as I say, some of my most successful investments have been where I've just thought that feels so low for what this company is needed and how entrenched it is in everyday life. And so I've entered investments when it's been some of the biggest drops. Now, when you look at the equity market through time, it's been a cumulative or compounding exponential rise through time. And so you see these dips, but those dips might last for a week or a month. But by having a long investment mindset or a long holding period to your investments, you can hold out some of these what seemed scary fluctuations. So again, and I've said it before, it's take that step back. Don't react. But the rule I would say is going into every investment is try to say, okay, well, while I'm not invested right now, what would I want? What's the max I would be willing to lose?
Yeah.
But also have a look at how that company has, or that fund has behaved in time to get more familiar with, okay, well, 2 years ago, it went down 20%, but there was that fluctuation back up, to just know, I guess, feel through those moves on a look back basis, so that when you are in a 1 or 2 days of a drop down in share price
Or more.
then it's you know that that's been a behavior or a pattern that's happened before. Yeah, I think the main thing to say is generally investing has gone from long-term horizons. People used to hold investments for 5+ years, and now horizons have gone to weeks, if not a few months on average. But when we've tested investment strategies, those that have outperformed on an average annual basis have been those that have been buy and hold. Holding these for 5, 10, 15 years is the strategy globally that has outperformed fast moving in and out of investment holdings.
So yeah, buy and hold, great strategy, great starting point, looking at the fundamentals of the company. You've talked about your experience with impact investing and ESG. Can you tell us a little bit more? Because there could be some belief that when you're investing into something that's more sustainable, that has impact, you're maybe sacrificing return, which doesn't sound too good, because we need this level of sustainability. But if you could give us like a snapshot of the impact market, that'd be amazing.
It has got some of that connotations, and really because the last couple of years, some sustainable funds and impact funds have relatively underperformed global markets. That's relative, it's not absolute. So a lot of these funds are still doing well, the companies are still growing, but versus Nvidia and some of these tech stocks, then they're in their shadow a bit. So really, when we say all impact investing, sustainable investing is to drive long-term total returns. It's not concessionary, it's not giving up on returns. But a sustainable strategy can invest in less companies than a traditional strategy, because there are a lot of traditional companies that have a negative impact on the planet or people. So I would again look at the absolute returns of these funds. Bringing in our long-term investment thinking, these funds are set up for long-term success. These are investing in companies that have strong business models, that are providing products and services that are helping the world get to, or help set up the world, and in a place where there's positive outcomes for people and planet. So that's healthcare, education, green energy, efficiency. These are all structural themes that are helping to drive long-term returns for companies. Now, in the short-term fluctuations, there has been a bit more volatility with them. So they aren't lower return funds. They are set up for longer-term investment and might not have had relatively as high returns as some of the tech stocks have driven in the global fund.
And sometimes, it can be confusing for people when they start investing in this impact space. There's a lot of, acronyms, ESG, there's impact investing. Can you tell us, what is the difference, and how do you recognize funds that are, truly, that have, real values, they're looking for impact, versus maybe just the, the marketing, the, greenwashing and all these terms?
ESG is built for looking at the operations of a company. So you might be an oil and gas company, but operating really well. So you've got good human capital development, you're reducing your emissions, but you're still drilling for oil, and you've got good governance practices. So they are measuring how you operate as a company. And so, it's proven that some companies with higher ESG scores have outperformed those with lower. So it is a valid strategy. On the impact investing side, which is my world, is focused on how does a company's product and service drive a positive outcome on either people or planet. So this isn't necessarily around how they're operating, but it's what is that business model that is helping to drive positive outcomes. That could be anything from helping SMEs have a marketplace for selling their products to help elevate small, medium enterprises, which are the backbone of today's, or the most economies. It might be a healthcare company that's innovating with a really strong new product that is helping to improve the longevity of lives, save lives, and we're measuring that. And we measure that at Net Purpose. So looking at real-world outcomes, and what we've seen as a trend through time has been ESG was just the starting point, and now the industry is moving towards impact investing because it's what we really care about. Those that have a sustainable mission or a sustainable objective to their portfolios, they care about what's actually happening as an output of that investment, of that company that they're invested in.
And over the next, you've talked about a lot of sectors and you give us a lot of ideas that we can start researching.
Mm-hmm.
But where do you think the biggest opportunities for impact investing will be in the next 10, 20 years?
It's fascinating. And we talked about diversification. There's still so much diversification in impact investing. Green energy hasn't done as well as hoped in the last couple of years because it takes a lot of capital, capex, so expenses to build these green energy funds or plants or companies. And so energy efficiency is somewhere where I'm really excited about because those companies that are helping companies do more with less. So if we think Schneider Electric has been a phenomenal business that's helping businesses, buildings, infrastructure be able to operate with less energy usage. And so if we can't move the economy towards green energy quick enough, what we can do is drive efficiencies within everyday operations of businesses. I love some of the online education platforms. You had Duolingo and some of these exciting using tech and being still in the tech space, but allowing new ways of accessing information. So no matter where you are in the world, in an emerging market or wherever, being able to access education in the palm of your hands and being able to have that accessibility. Less jazzy, I guess, but as the planet heats up, there is a real need for air conditioning.
Yeah.
Now, air conditioning has historically been a very energy-intensive operation. And so those companies on the leading edge of developing air conditioning that's not only energy efficient, but affordable for families that will be struggling in some of the closest to the equator countries that need to cool their homes because temperatures are just so high in summer months. These are the companies that are going to be really needed to keep food cool or to cool homes. So a bit less exciting on the surface, but really helping to improve the lives of people and the efficiency piece helping to improve the outcomes for the planet.
Amazing. Let's wrap up.
Yes.
3 quick-fire questions.
Okay.
Biggest investment myth?
Biggest investment myth that it's scary and just for professionals.
Yeah.
And jump in as soon as you can.
One thing people overthink when investing?
I would say they overthink by seeing stocks going up and then think they'll wait for a pullback in the returns. But actually, if you have a long-term investment mindset, just get invested today.
One signal you personally pay attention to that most people ignore?
I look at, as I think has come through this conversation, is this product or service going to be around when I'm retiring? Am I going to still be relying on it in many years' time?
Amazing. Thank you so much, Caroline.
Thank you for having me. It's been brilliant chatting.
Thank you for joining us today on The Wallet. You can watch the full episode on YouTube or subscribe to The Wallet on your favorite podcast platform. We also share clips on social media at Vestpod, and you will find the key takeaways and resources from this episode at vestpod.com. Thank you for listening.